I think you're going to see gold a lot higher than it is now. So let's say gold goes to $10,000 an ounce, like Jamie Dimon is now saying. Uh, uh, if it goes to $10,000 an ounce and you've got a 20 to 1 gold silver ratio, you're talking about that's $2,000 silver, isn't it? And you end up with these price projections that range from $200 to about $2,000. I mean, some of them just are absurd, except it's just math. And the thing is that we have a tremendous shortage and a lack of supply of silver right now.
Renowned financial educator Mike Maloney shares a striking outlook on the future of precious metals, suggesting gold could climb to $10,000 per ounce, echoing recent forecasts from major financial leaders. If this happens and the gold-to-silver ratio tightens to 20.1, it implies silver could surge to $2,000 per ounce, a potential once-in-a-lifetime move. Maloney points out that this isn't speculation but simple math backed by real-world shortages. The global silver supply remains under intense pressure from both industrial demand and investor accumulation. With limited new production and rising consumption in technology, solar and green energy sectors, silver's scarcity could magnify price movements. The growing imbalance between paper contracts and physical metal availability reinforces this bullish scenario. As gold and silver continue to decouple from fiat currency weakness, understanding this shift is crucial for investors positioning for what could be a historic metals rally. If you found this helpful, like, share, and subscribe to The Metal Bar, turn on the bell so you don't miss any updates, and comment below to share your thoughts on it. Appreciate you for tuning in. Now, listen to the interview.
I try to not make my investment decisions based on emotions. And so I use the gold-silver ratio to tell me whether or not to buy gold or silver. And because the gold-silver ratio has been so out of whack, I own 300 ounces of silver for every ounce of gold. It will come back into balance one day. We don't know when. It's going to take a little while. But I believe you're going to see the gold-silver ratio in the 20s or less. In other words, right now it takes 85 ounces of silver to equal the value of 1 ounce of gold. If it takes 80 and you buy silver and it goes down to 20 and you sell your silver and buy gold with it, you just got 4 times more gold than you paid for. And so it's a strategy that can be back tested. It works. And for 2,500 years, the average exchange rate was about 13 to 16, somewhere in that range, ounces of silver to 1 ounce of gold. So this is something that has only existed since the big discoveries of the Comstock lode and the Silver Valley in Coeur d'Alene, Idaho, back in the late 1800s, and simultaneously governments around the world went on the classical gold standard and treasuries dishoarded their stockpiles of silver. And so all this silver flooded onto the market and silver's value plummeted compared to gold's value. And it has bounced up and down, but we've been at these historic high areas of like 100 to 1, and during COVID, 120 to 1, which had never happened. In 2,500 years of gold and silver being money, that had never happened. I do believe that there is a giant crisis heading towards us. If you look at like the 1929, that was a stock market bubble only. Real estate was not in a bubble. Gold was fixed. It was $20.67 an ounce. And then you go to 1966, stocks were in a bubble and they corrected from 66 to 1982. The Dow Jones bumped its head on 1,000 points and couldn't break through from 66 to 82. And during that time, we had raging inflation. Company profits went up, the number of dollars that they were in. So all the price earnings ratio, the PE, all the ways that you can measure whether a stock market is in a bubble or not, it corrected, and stocks became severely undervalued by 1982. Then we went into the tech bubble in 1999, 2000, and stocks were extremely overvalued and then crashed, and we ended up with, each one of these crashes and corrections. I don't know, there's not that many people that recall the 1970s, but the raging inflation we had and then the double dip recession that we had at the beginning of the Reagan era, there were some pretty tough times, even though we didn't have a major stock market crash. We had this slow grinding correction. With the NASDAQ bubble, we had a major stock market crash that ended up in a recession, but real estate was not overvalued. Then we get to the global financial crisis. Stocks were not overvalued. They were back down in the fair value region because of the NASDAQ crash, and it was real estate that was in a bubble. Today, we have historic bubbles in real estate, stocks, and bonds. And I mean, the only way that you can measure stocks that doesn't show them in the largest bubble in history, it shows them in the second largest, is PE ratios. But every other indicator shows stocks being more overvalued than at any point in history. And then when you look at commercial real estate and residential, same thing. It's the more overvalued than we were in 2007. And so it's going to be a crash of all of these asset classes against gold and silver.
In this powerful discussion, financial educator Mike Maloney breaks down how the gold-silver ratio reveals critical signals about global markets. Today, it takes 85 ounces of silver to equal 1 ounce of gold, a historic imbalance compared to the 2,500-year average of just 13 to 16 to 1. Maloney explains why this extreme divergence suggests that silver is dramatically undervalued, and why patient investors could see enormous upside as the ratio returns to equilibrium in the coming years. Historically, every time the gold-silver ratio rebalances, silver dramatically outperforms gold. By using the ratio as a strategic tool rather than emotion-based investing, Maloney shows how investors can multiply their gold holdings over time. But the warning goes deeper. Maloney highlights that today's financial system is flashing danger across stocks, bonds, and real estate, all showing signs of historic overvaluation. Unlike past crises where only one sector was in a bubble, this time all three are simultaneously overextended. That convergence, he warns, could ignite a massive correction across global asset classes, with gold and silver standing as the ultimate safe havens. With inflation rising, markets distorted by decades of easy money, and debt levels soaring, the setup for precious metals has never been stronger. Let's get into the interview.
Mainstream banks, Morgan Stanley, recommending to go from a 60-40 portfolio, 60% stocks, 40% bonds, to 60% stocks, 20% bonds, and 20% gold. So they're saying sell half of your bond holdings and convert them to gold. This is just like a whole new world. This, to me, signals the beginning of the third and final phase of a bull market. And that is where you have the greatest amount of gains in the shortest period of time. So we should be seeing some fireworks coming. Gold is still a very popular wedding gift, but it wasn't investment coins and bars. And then you look at Africa and South America and how incredibly poor they were back then. In the United States, it wasn't legal for Americans to own gold until the first day of 1975, and for Australia, the first day of 1976. And so, really, it was only Western Europe, not Eastern Europe, but Western Europe and Canada driving the gold price. And then in 1975, the U.S. joined the party, 1976, Australia. But still, it was only 10% of the world's population. With the increase in the population of the planet since then, and then the fact that today it's every country on the planet except North Korea. They're the only ones that can't invest in gold and silver. And there are now exchanges all over the planet. There's exchanges in China, in Russia, in India, and they're everywhere. And so there's basically 18 times more people that can come chasing gold and silver this time around. And when I wrote the book, summer of 2022 is when this data came from. There was the OECD said that there was 55 times more currency on the planet, national fiat currencies. Well, we've recalculated that since then, and it's closer to 80 times more currency. So you're talking about 18 times more people with 80 times more currency coming chasing a pile of gold that's only twice the size that it was back in 1980. And don't know. I think the pile of silver is actually smaller than it was back in 1980.
Financial analyst Mike Maloney outlines why we may be entering the third and most explosive phase of the gold bull market, where the biggest gains happen in the shortest amount of time. Major institutions like Morgan Stanley are shifting traditional portfolios from the classic 60-40 model to 20% gold exposure, signaling a historic change in mainstream investment strategy. This isn't just a Western trend, it's global. Unlike the late 1970s, when only a handful of countries could invest in gold, today nearly the entire planet can participate. That means 18 times more people with nearly 80 times more fiat currency are now competing for a supply of gold that's barely doubled since 1980, and a silver supply that may actually be smaller. With global demand rising and traditional assets flashing warning signs, the setup for precious metals could lead to a parabolic move, unlike anything in history. Gold and silver are no longer just safe havens. They're becoming the foundation of the new financial order. If you found this helpful, like, share, and subscribe to The Metal Bar. Turn on the bell so you don't miss any updates, and comment below to share your thoughts on it. Appreciate you for tuning in.